Hello, this is Matthew Copley with Copley Financial Group, and we're going to do a market update today primarily because of the crazy bank runs that are going on and Silicon Valley Bank crashing, and I want to assure everyone that we're on top of it and also let you know what caused it, what's going on, and what to expect in the future. And so Silicon Valley Bank, this was a big bank, 18th largest bank in the United States, went bankrupt. Failed. And this is the largest bank failure since Lehman Brothers, actually the second largest bank failure ever in the history of the United States. And so what caused it? Well, really what caused it, you have to go back to what the Federal Reserve was doing with lowering interest rates. Everyone talks about what caused this is the Fed has raised rates too quickly, and the raising of rates caused the whole bank to fail. But really that's not the truth. The truth is that the Fed lowering interest rates a few years ago to ridiculously low levels and the quantitative easing and all of that is what sowed the seeds of what's going on right now. And so you have to understand why this bank failed. There was nothing wrong with the bank. The bank was doing everything they were supposed to do, and the regulators kind of forced them to buy certain securities. Now, you can argue that they did a really horrible job hedging the interest rate risk, and they went way too far out on the yield curve, and they made a big mistake, and it was a problem, and all of those bankers should get fired and the whole bit. I agree with that. But you have to understand that they were doing essentially what they were supposed to be doing according to the bank regulators. And what that is when they have excess reserves, what they do is they buy investments that create a return. And so they had a ton of depositors. You had all of these Silicon Valley companies that are a lot of these venture startups that have a lot of cash. They're putting money at the bank. And that bank would then take that money and buy investments to make a spread. And unfortunately, what that bank did is they bought a lot of investments while interest rates were really low, and they bought long maturity debt. And so now that interest rates are a lot higher, that debt is worth a lot less if they are forced to sell it. And so what they do is they hold all this debt under what's called hold to maturity. And so I'll give you a perfect example is I have a $1.4 million mortgage on my house, and the interest rate is 2.625%. I refinanced it when the rates were very, very low. And so currently my bank that owns that mortgage has that as a $1.4 million mortgage. But it's not worth $1.4 million if they were forced to liquidate right now, because current interest rates on 30-year fixed are 6.5%. So if you take a look at the current rates and you take a look at what my mortgage is really worth if they were forced to sell it, is my mortgage is only worth about $900,000. So $1.4 million is only worth $900,000. Now on the bank books it says there's $1.4 million, but if they were forced to sell my loan to another bank or to another investor, they would only get $900,000 for that loan. Now, as long as the bank doesn't have to sell and they hold it during the whole 28 plus years that I have to pay left, they're going to be fine and they're going to get all their money. But if they are forced to sell, there's a problem. So what forces them to sell? Well, depositors wanting their money back. And so if more depositors want their money back than the bank has on current assets, they are forced to sell those other assets. Well, this is what happened with Silicon Valley Bank. They had all these assets, they were forced to sell it, and then they became underwater, and so they failed. And this is something that should have been known. I think the Federal Reserve did know this was going to happen. In fact, there was a recent leak on the Federal Reserve. They actually had a committee. It was called Systemic Resolution Committee. This is a committee that meets at the Federal Reserve, and this video leaked. This was back in November, and they said in this video there would be defaults and bank runs. So they knew this was going to happen. I would have thought they would have been a little more proactive looking at these banks to see who's at risk and the whole bit. Silicon Valley Bank's clearly at major risk. And so at the end of the day, it's an old-fashioned bank run, just like we had in 1929, that people rushed to take all their money out, and it created a bank failure. Now, is this going to spread? Well, I don't believe so. what we've seen is the government is going to come in, I believe, and bail everyone out, and not just the 250,000 FDIC limit. I think they're going to bail out all depositors. We live in a world where everyone gets a trophy, no one loses, and they're going to bail everyone out. And this is a problem with inflation, but this is what I believe is going to happen. And I don't think anyone's going to lose any money. And there's a lot of these Silicon Valley banks, they're politically connected. A lot of these corporations, they had a lot of cash there. You look at some of these big companies like Roku had $487 million at Silicon Valley Bank. Technically, $250,000 is insured. I think there was a company called Circle had $3.3 billion. There was a company called Roblox. This is like a kids video game company. They had over 100 million. And so this is money that technically should be lost. Or at least the balance of the bank pays back some of that money. And so when you're looking at those kind of losses, I just don't think they're going to allow it to happen. A lot of these companies in Silicon Valley, they would be unable to make payroll. You're going to see the Federal Reserve come in and bail it out. So what are some other companies that are at risk? Well, Goldman Sachs has a list of shorts. They said that First Republic Bank, Zion Bank, Key Bank, and Truist One were all banks that would fail. Another one they named was Signature Bank, which just failed. They were tied in a lot with the crypto industry, which the very first bank to fail actually was Silvergate before the Silicon Valley Bank, and they were a crypto bank tied into the crypto industry. And so this is what's going on. Now, I personally don't believe that a lot of these other banks have the same risk that Silicon Valley Bank does. For example, First Republic has 16% of their reserves in securities, where Silicon Valley Bank was 57%. So it was really an outlier. They had no hedges against any of their portfolio. I don't know whether First Republic does or not, but looking at the numbers, it just doesn't look the same. It looks like this may be a one-off. Now, of course, there could be a bank run and everyone could run and get their money out. I just don't see that happening, and I think the Fed has made it pretty clear that they're going to make all depositors whole, even the ones above the 250,000. So. One I am watching closely, which is a concern, is Credit Suisse. And of course, this is not a U.S. bank. This is a bank out of Switzerland. And just out of an abundance of caution, last week when we saw some of this coming, we actually completely liquidated all positions tied to Credit Suisse. So it was about $4 million, which isn't a lot out of $300 million that we have in assets under management, but we sold all those positions. So if you are one of those clients that did have some exposure to Credit Suisse, this is we eliminated all that exposure last week. And so this is a bank that is a major bank out of Switzerland. I don't believe they're going to let them fail. I think the Swiss government's going to get involved and bail out the banks. And so I don't think that's going to be an issue, but it is one that I'm watching very, very closely. Another thing that we're watching is just the overall debt. I do think that this is a problem. The Fed has $8.5 trillion in these reserve assets. And unfortunately, when you have $8.5 trillion that is worth a lot less than what it really is worth, they have to hold all that to maturity, so they can't sell any of this debt. It's not going to get sold out of the market. So inflation is just going to win. And you go back to Roman times, this isn't anything new. This is what governments do. They print up a lot of money, they debase the currency, and inflation goes wild. And I do not believe the Federal Reserve is going to choose the route of blowing up the market by letting all these depositors lose all their money above 250,000. I don't think it's going to happen. They're going to bail everyone out, and we're just going to have lots of inflation. And what the government's doing, the current administration leadership, it's fiscal insanity. I don't understand it. Biden announced a $10 trillion budget. The actual numbers that they are expecting is that the current debt's going to go from 30 trillion to 50 trillion over the next 10 years. In the face of all of this current debt, they're just going to pile it on. This is going to cause tons of inflation. And of course, the risk that we have now is the rest of the world is basically saying we don't want to be part of this anymore. And the BRICS nations, which is Brazil, Russia, India, and China, they have announced that they are going to go to a commodity-backed currency. And that's going to put a lot of pressure on the US dollar and the West. I think the future world probably looks more like zones. You have the West zone, which is going to be US and Europe and Japan. And then you have the East zone, which is going to be China and Russia. And, there'll probably be a lot of neutral countries in between, like India and Indonesia, that try to, thread the line and provide commodities to both sides and make money off both sides. And I think this is kind of what we're seeing. At some point, we're going to have to go back to real money, which is gold and silver, or commodity-backed money, which is what the BRICS are talking about. And the sooner the government cuts government spending and gets the debt under control, the better. But they're just going to inflate their way out of it. So what do we do right now? Well, first thing you got to do is make sure that you do stay under the 250,000 limit, just in case there's a problem. And so spread your money around to the various banks. Make sure you stay under the 250,000. I do have a banking relationship with First Republic. We have some accounts there, and I make sure that I stay under the 250 limit. I always have, and I've got quite a bit of assets at Wells Fargo and Chase and various other banks as well. Just diversify that money out there. And also understand that banks are not the safest place. And the reason for this is the banks turn around and use your deposits to invest, and sometimes they make really bad investments, which is clearly the case with Silicon Valley Bank. So annuities are much safer. So I think that take advantage of the high interest rates on annuities right now, especially the MYGAs, the multi-year guarantee annuities. The 5.4% 3-year was extended. We expected that to go away at the beginning of March, and they extended that rate. I don't know how much longer it's going to last, especially as we slide more into a recession, which is what all the data is showing us. At some point, rates are going to come back down. So I'd rather get 5% or 5.4 for the next 3 years than get 6% for the next 6 months, which you can get in some places, just because one's only going to last a short time. I'd rather have the higher interest rate for longer. And so take advantage of that. Make sure you own high quality dividend stocks, good companies with good dividends and cash flow. And you got to understand, since 1981, the interest rates have gone straight down. I mean, it's just been a downward slope all the way since 1981. And of course, stocks and real estate and bonds all did phenomenal during that period. We have the opposite now. Now interest rates are coming up. And you go back before 1981, I'll give you an example. January 1st, 1981, the Dow was at 800. Well, January 1st, 1964, the Dow was at 800. That's 17 years. No growth in the stock market. Of course, inflation was going wild in the 70s. But you got to understand, during that time, a lot of companies still provided a lot of dividends. And so the average dividend yield between 1964 and 1981 was over 6%. So even though the stock market prices didn't go anywhere, a lot of companies were paying good dividends, and even higher on companies that were commodity based. And this is something we need to make sure that we're in. We want to be in high quality companies that pay good dividends, that make money on food production and energy production and materials and infrastructure. These are companies going to do fine. So we want to be in those companies, and we want to hedge against stock market risk. That's where the buffered index comes in. It's a great investment, which we recommend, and it's really saved us big time over the last year with the stock market coming down. A lot of those buffered indexes that are maturing right now, you're getting fully reimbursed on all of the loss for the year. So those are great investments. So take advantage of the great annuity rates right now. Take advantage of investing in good quality companies while the market's down. And then the other thing, real estate's okay as long as it's got high cash flow and low debt ratio. And so we do have real estate investments that we can get into that have good cash flow, low debt ratio. And then I think we're going to be fine. So I know there's a lot of conspiracy theorists out there that say this is the beginning of the Great Reset and they're going to crash the banking system and they're going to come in with a digital currency. And, the government does want a digital currency. They want to be able to track what everyone buys. They want to be able to collect all the taxes. I mean, a digital currency is a dream for, governments. But is this really going to be the trigger? I don't think so. I think if we are going to get pushed into this great reset or whatever they're talking about, it's going to be something a lot bigger. Two things that I would look out for is one is Japan. Japan's in a major problem, and if Japan collapses under the weight of all their debt, that could be a major event that affects the whole world. That's a thing to watch. So Japan would be a much bigger, if the whole country crashed into hyperinflation, then Japan would be, a much bigger trigger than the current, Silicon Valley Bank. And of course, if something major happens, the government is going to probably step in and get involved and do a lot. So in the 1930s, they actually shut down all the banks for several days and came back and reset everything with massive inflation. They took gold from $20 an ounce to $35 an ounce in a real short period of time. And they could do that again, to just shut everything down. Maybe it'll be an internet hack where the whole internet will get hacked and it'll be the Russians or the Chinese that did it, and they'll just shut everything down. And when they bring everything back online, they'll have more censorship, they'll have much more control, they'll try to introduce digital currency. I mean, this is all conspiracy theory that's reasonable, right? The current situation is not something that I would dive into this whole conspiracy theory on. So anyhow, we're watching all your accounts. We're taking care of everything here. We're keeping ahead of what's going on. And if you have any questions or concerns, feel free to reach out to us. We'll be happy to chat with you about your individual accounts. And if you're not a client, give us a call. We'll be happy to put you in a good position. I think a lot of financial advisors today don't understand what's really going on, and they're not positioning their clients the right way. And I think we're going to ultimately see that our clients will do much better over the next 5 years because we understand what's going on.